Hi and welcome to the Financial Fox. Uncertainty is the word of the moment, especially for investment. There is the Brexit situation in the UK, of course, but we also saw the energy market shaken up by the recent Saudi Arabia attacks and also the global economy threatened by politically motivated trades, along with the rise of tech that is disrupting the old status quo of the financial markets. To talk more about this, here with me today is City Fund Manager Angelos Damaskos, CEO of Sector Investment Managers, a London-based investment management company focused on natural resources. Hi Angelos, welcome.
Hi Stefania, thank you for inviting me.
It is great really to have you here.
Thank you.
What I would like to do, just to start with, is if you could give us a little bit more information about your background and also about your company.
Sure. Well, I have, my entire career has focused on financing natural resource projects. And in 2004, I set up Sector Investment Managers as a specialist investment management company with an exclusive focus in precious metals and oil and gas. So we started our oil fund, the Junior Oils Trust, in 2004. So we've run it for about 15 years now, focusing in smaller capitalization companies with growing operations in safe political jurisdictions. So we do not invest in Russia, the Stans, and other politically unstable territories because we think that political risk is something that we cannot evaluate and we cannot properly factor in our models. Then in 2009, we launched our Junior Gold Fund that, as the name suggests, focuses in gold and silver mining companies. And that was in the aftermath of the financial crisis of 2008, when gold behaved much better, performed much better than any other asset class. And it was clear that we were in for a multi-year bull market for precious metals. So we have developed these two funds alongside our other investment operations that span private equity and public equities. And these funds function as sector allocation tools. So effectively, any investor that wishes to have exposure in smaller capitalization companies that are more difficult to research and understand, rather than constructing a portfolio of their own, could participate via our funds, which naturally follow the sentiment and the development in the underlying sectors.
So what kind of companies are you targeting geographically, but also what are the elements, the key elements that you are looking for in an investment?
Well, the key elements in our approach are resources. So we want to invest in companies that control sizable resources in the ground, be it oil and gas or precious metals, because we believe that ultimately the resource is the store of value that will transpire as the company continues to evaluate their potential and bring them to production in the most cost-effective manner. The second element, and probably equally important, is the competence of the management team. We want the company to be managed by people who have not only experience in the specific sector and the commodity, but also in the location of operations. So they know the regime, they know the regulatory policy, they know how to bring the resource to the market in the most cost-effective manner. And last but not least is the capital structure of the company. We want to see a solid balance sheet that is not over-leveraged, that will sustain the company during potential weak periods in the commodity price, so that our investment can be sustained through the long run.
Where are your main investments? Are they on the London stock market or on different markets?
We invest in the global markets, but we have evolved our policy and our portfolios to focus primarily in Canadian listed and Australian listed equities. The oil fund has a slightly bigger component of UK listed with about exposure of about 20%, but still the rest, 80%, is split almost equally between Canadian and Australian listed equities. And the reason for that, whereas, I beg your pardon, to complete, whereas the gold fund is almost 60% weight towards Canadian listed companies and 40% to Australian listed companies. The reason for that is that these two markets in Canada and Australia have evolved as the main destinations for resource focused small cap companies, and there is a great plethora of companies to look at and evaluate and select the best of breed, so to speak, that we would like to include in our portfolios. So we have access to a large number of names. We have access to the best management teams and companies that operate in the jurisdictions that we like.
Okay, let's start to talk a little bit more about oil. So the oil market has been pretty volatile, particularly after the Saudi Arabia attacks. And although Saudi Arabia apparently has basically stabilized the situation, bringing back almost 10 million barrels a day, it seems that there are some other concerns. For example, the geopolitical risk that now should actually is worth to be considered within the price of oil. What do you think? What are your considerations regarding this event, and how do you think this event has impacted the energy sector?
Well, in the short term, it appears that the market has chosen to almost ignore the event, and the prices have been restored to the previous level before this terrible attack. But having said that, we believe that the geopolitical risk in the Middle East has not subsided. There is clearly a lot of tension with Iran being landlocked and being boxed in by the US sanctions, and as well as all the other friction with Syria, between Saudi Arabia and the other neighbors, Yemen. So there are all sorts of issues that we think could evolve in future that could again disrupt production. However, the market seems to be taking the view that there is plenty of supply coming out of North America in particular, and the shale oil of North America has kept growing over the last couple of years. In our assessment, and from the data that we receive from very solid and reputable sources such as the International Energy Agency, we see that the US growth of production has started slowing. And the reason is for this is primarily the undercapitalization of the US-focused oil companies. As we have discussed earlier, there has been a very, very negative sentiment against oil companies, particularly the ones that are focusing in US and Canadian shale oil. So their share prices have declined tremendously, and therefore there is less capital that is available to those companies. The result of that is that the rate of utilization of drilling rigs in America has started declining very rapidly in the last few months. And that means that the production profile is going to follow very soon.
But do you think with this situation and going forward, would that event spur more interest, for example, in alternative energies? I mean, we saw that renewable energies outperform oil and gas stocks in 2017 and 2018, if I'm not wrong. So do you think this Saudi attack was kind of emblematic and now is going to get a little bit more interest within renewable energy, for example, or other source of energy?
Well, I think the growth of interest in renewable energy is not dependent on the supply and demand for oil. I think it has to do with the general concerns about global warming, environmental pollution, and so on and so forth. So naturally, people are thinking that we ought to reduce our carbon footprint, and many believe that alternative energies are the way to do that. I have very strong opinions on that personally and based on my research, and I believe that alternative energy is not necessarily the answer to the environmental problems, because in order to build the equipment and the machines to generate the alternative energy, the input, the energy input and the carbon footprint is colossal. Plus, all of that equipment within a 10-year lifespan has to be replaced. So we'll have to build it again. Whereas we have abundant oil and gas in the world, particularly gas, which is a very clean and very efficient form of energy, form of input for energy and power generation. It is wrong, really, to point the finger to the hydrocarbon industry as the culprits for global warming.
Talking a little bit more about oil, I mean, the collapse of oil prices in 2014 hit the oil industry quite hard, particularly less capital is being invested in exploration, and that's why oil discovery, they are at the lowest level over many years. Where do you think there are still opportunities in the oil and gas?
I think the reason for the collapse in oil prices in 2014 was clearly the growth of the shale business out of North America. Very few people anticipated how successful the North American industry would be in extracting oil and gas so efficiently from tight rock. And there has been a huge growth in supply that made America, of course, energy independent. So it's a huge boon for America. Now, the other side of this story is that it has caused a dramatic collapse in exploration activity in the rest of the world and has caused a lot of pain in other energy-producing countries. So we are seeing global decline in production in the rest of the world that is being offset by the growth in shale oil production. So I think there are still opportunities in certain markets, such as Latin America, West Africa, and perhaps Australia, Indonesia, for growth for attractive discoveries. But clearly, we live in a market where we are trying to assess the impact of the growth in U.S. shale and the potential balancing of the global trade flows to establish which are the next possible candidates for growth.
When you talk about oil, many people would think about North Sea. What do you think is happening there?
Well, the North Sea has been in decline, particularly the UK shelf of the North Sea has been in decline for the last 10 years now. And we have seen many of the oil majors withdrawing from their activities there, and some of the fallow assets being picked up by smaller independent companies that have had some success in finding new fields and through exploration, but generally the new discoveries have been very small and far between to make a net gain in the UK production. On the Norwegian side of the North Sea shelf, there has been some success, notably the Johan Sverdrup discovery a couple of years ago was the largest discovery in over 30 years. So there has been some growth in production coming out of the Norwegian side as the Johan Sverdrup project is coming into production, I understand, next month. So it's kind of a mixed bag. On the UK side, we are seeing continued decline in production. On the Norwegian side, there is some growth. On a net basis, the general North Sea basin appears to be at best flat.
We know the problem about Brexit and concern about energy security as well. Being probably gas the best source of energy over oil for energy security, do you see any opportunity maybe within the small cap company, the small independent British oil and gas company?
Well, there are some small companies that are focusing in gas on the UK side of the border. But I find it difficult to believe to accept that as a result of Brexit, there's going to be a big problem in imports of gas from the pipeline system coming from Russia and Northern Europe, via Northern Europe. So overall, I think over the next couple of years, I very much doubt that there's going to be a problem in terms of the energy security for the UK.
Okay, so let's now talk a little bit about natural resources, particularly gold and precious metals, which has been seen as a safe haven assets, particularly in time of market volatility. Now, talking about gold, gold has been doing fantastically. I mean, the price started to rise in June, and then they hit the highest in August. Now they went down a little bit, but analysts are still very bullish on gold. What are your views, and how do you see the gold price trend?
Well, as you know, I have been a long-term bull for the gold price, obviously manifested by my management operations, and not only with the gold fund. But in the last few months, we have seen this important breakout in price that you mentioned that started in June. And that indicated to many of us that things had changed in terms of the international perception of investors and the acceptance of gold as a safe haven asset and as an alternative investment to equities. I believe there have been several catalysts for that. The main, of course, is geopolitics. We have had not only the Iranian situation and the Syrian war, as well as the general instability in the Middle East. We have also had a general standoff between Russia and the West, with many sanctions imposed on Russia. For example, Russia has shifted its entire US Treasury reserves into gold over the last year and a half. And we have also seen the trade wars that have been initiated and supported by the US administration. So all of these things have raised the risk awareness of investors, and many believe that we have reached a top in the equity markets, particularly with the possibility of a recession in the developed markets and a slowdown in the emerging growth economies, principally China and India. There is a strong likelihood we could have a global recessionary environment. So equities are unlikely to do well in an environment where we have recessionary forces. So investors naturally are looking for alternatives. And in a world where we have $17 trillion of sovereign bonds negative yielding, i.e. investors have to actually pay to hold bonds, people are looking for alternatives. And naturally, among safe haven assets, gold and silver are the most principal safe haven assets since antiquity. So people have been buying gold. And this is evidenced not only by the growth in gold-backed ETFs that retail and institutional investors seem to choose to gain exposure to gold bullion, but is also evidenced by many central banks buying into gold and increasing their reserve allocation very, very strongly.
So you mentioned before the economic slowdown and the trade war between China and US, and now actually the gold and the dollars, they are performing, which is quite different from the usual trend. Usually they had an inverted relationship, and now It seems they are going along together. Why do you think that is happening?
Absolutely. I think in my reading, this is one of the very bullish factors for gold, that gold is moving in linear correlation to the US dollar for the last 9 months. And it demonstrates how the demand for gold is actually pushing its price up regardless of what the dollar is doing. Now, there is also an element to note here that the Federal Reserve, as you are probably aware, has changed its stance dramatically over the last 9 months. From being in a very sort of aggressive, hawkish position, wanting to raise interest rates to contain inflation, they have suddenly changed tack and have started cutting rates. This was a big event for the markets that indicated that we will be likely in a prolonged period of very low and possibly negative interest rates, and that is good for gold.
Looking at other precious metals such as silver and palladium, what are your views? What are the trends here?
I am very bullish on both metals, a little bit more bullish on silver than palladium, because palladium has had a very strong rally over the last year, and it might be reaching levels that cannot run very hard from here. But silver has underperformed gold for over 6 or 7 years now, and silver tends to be much more volatile than gold. So in times of a bearish negative sentiment for gold, silver tends to do much worse. And then the corollary happens. When gold starts getting into a strong uptrend, silver tends to outperform it and rise much faster. So we seem to have reached that point in June of this year, when the gold to silver ratio, that is how many times the silver price goes into the price of gold, reached a rate of 92. And now silver has started outperforming in the last couple of months, and we are back to about 82 to 80, tending to 80. So the long-term average over 30 years of the gold to silver ratio is 66. But there have been times when this ratio has actually dropped to well below 50, which means that silver should reach, at current gold prices, if we were to assume the long-term average of 66, silver should trade above 30.
Yeah, that's pretty impressive. But going away from precious metals, let's talk a little bit more about different kind of base metals, which they become quite popular, particularly because the technology revolution and the material, the different material they are needed. Where do you see, which are the main elements, and where do you see the potential here?
Well, the most important base metal, of course, is copper, that is used not only for electrification and all the industrial applications of a fast-growing economy such as China or India, for example, but it is also used in many high-technology applications, because copper is a very good conductor of electricity and is used in many electrical appliances. The problem with copper at the moment, the way I see it, is the slowdown in the Chinese economy. As the Chinese economy slows down and is impacted by the trade wars and the general economic slowdown in the developed economies, demand for each product tends to slow, and therefore they tend to need less copper input to their whole economy. So I expect that prices of copper might remain a little bit subdued until we see the light of the Chinese economic development.
What about nickel, zinc?
Nickel, zinc are also very important in many industrial applications, and they will generally follow the same pattern of the global economy. I expect to have something, a similar impact. And obviously there are different relationships for each metal as they have a different supply and demand pattern. I understand, for example, that copper could be entering a serious deficit of supply to demand over the next year, but that again assumes that demand remains healthy, particularly from the growing economies of China and India, to maintain this deficit and pull prices higher. But generally, I'm a little bit cautious and a little bit, conservative in positioning in base metals at the moment. I'm much more excited by gold and silver as safe haven assets in today's economic and political environment.
Yeah, picking up on this, just to wrap it up, what will be your message to investors in this particular current climate?
Well, I think any sensible, well-diversified portfolio should have a very strong allocation to safe haven assets, particularly gold and silver. And I think a sensible allocation would be to have some exposure to the bullion via ETFs or actual physical gold and silver if you can get it and you can store it safely. Then some exposure to the senior miners, which are the more solid operations that have a long-standing record of production, and then some perhaps another third of exposure to the more junior companies that are the growth engines of the industry. These are the companies that control the assets that will be the future supply of commodity, and they are naturally the takeover targets of the mid and larger companies when they realize that prices are rising strongly and they need to boost their growth pipeline.
Okay, but would you prefer production, or you would also look at some exploration?
I think there has to be a combination, but we generally avoid grassroots exploration because it's very, very risky and very uncertain. We will buy into a company that has discovered a material resource and is continuing to drill to enhance its understanding about the resource, rather than buy in a company that controls a land package that has some prospectivity but has not been drilled properly, has not been understood yet. So we like the sort of late stage exploration that will be the next project generator in the pipeline, rather than something that is unexpected and could potentially offer very large upside, but is very uncertain.
Okay, Angelos, thank you very much for your insight. It was great. And let's see how the market is going to react in the next months.
Pleasure.
Thank you. This is everything from the Financial Fox. I see you next time.